The Bank of England meets this week to announce its decision on interest rates, just a week ahead of the trigger date of Article 50. What will it say? What can it say? As the whole country appears to be held up by the mechanics of political life in Westminster. Andrew Wishart joins us now from Capital Economics, where he's an economist. Andrew, very quickly, what are we expecting from the Bank of England this week? Anything or nothing?
No, I think the Bank of England are quite happy to keep fairly low profile this week. I think all the members will vote to keep rates unchanged. But you know, when we do finally get a Brexit resolution one way or another, then we don't think it will be too long before they do alter interest rates. Okay,
let's park the interest rate position to one side just for a minute and just pick up on that point about a resolution to the Brexit issue. Let's assume we get a nice, easy settlement of Theresa May's deal at some point in the next few weeks on a short extension. What economic picture then gets painted of the British economy?
Well, I think the Bank of England has sort of suggested that the sort of slowdown in growth we've seen recently, it means that, you know, there might be a bit longer now before interest rates rise again. But I think this morning's labour market numbers suggest that may well not be the case. You know, wage growth still very strong. All measures of labour market slack, suggesting there's really not any. So that means that, you know, we could see strong wage growth pass through to inflation, and that puts the bank on notice that they might need to raise rates. And we think if there was a deal in the next few weeks, which of course looks unlikely, perhaps 2 hikes this year.
Right, 2 quarter-point hikes?
That's right,
We're currently standing at 0.75, so that would take up to 1.25. Let's just bring up a chart of sterling against the US dollar if we can. What is being priced in at these levels? 132.84 at the moment.
So we think a delay to Brexit is probably, you know, is basically priced in now. We think there's a 5% chance of sort of an accidental no deal happening on the trigger date. So in the near term, maybe not too much upside. If we do get a deal, either in the next few weeks or the next few months, then we think there's scope for sterling to rally and eventually to 140. If we do get a withdrawal agreement at some point. The timing of that is what's really uncertain.
That takes us all the way up to this upper line up here, 140, which should be the highest we've seen sterling dollar at since April last year. Just talk to us a little bit about the downside then. Let's assume that that small percentage point you were talking about of a no deal Brexit by accident on the 29th of March. What happens then to sterling and the British economy? So
in that case, despite the banks saying it might have to raise interest rates, we just can't see that happening. We think the shock to demand would be the main thing, and therefore they cut rates probably to 0.25%. Some people have spoken about QE coming on, but we do think the bank would not plunk straight for that, just because, you know, there is going to be this supply shock as well, and we think perhaps demand could bounce back quite quickly.
Well, that's an interesting point as well, because if you are suggesting then sterling drops in the event that 5% chance of no deal or whatever, if it might happen, if the pound drops, that brings in inflation. Why is the Bank of England even in a position then to cut interest rates if you're getting in upward moves in prices?
Well, the bank is sort of worried about the longer term outlook for inflation. We saw after the referendum that, you know, they cut rates when the fall in the pound pushed inflation up, and this could be the opposite. You know, that the pound falls, but they also cut rates. But the same response, because although you do get some short term impact on import prices, the longer term is, you know, demand has fallen back. Perhaps we see a small rise in unemployment, and that just means over the medium to longer term, 2 to 5 years out, you know, the fall in the pound isn't going to keep inflation high over that horizon.
Right. Okay. Let's just ask one more question about Brexit and the Bank of England before we move back to the longer term picture for the Bank of England. On the assumption that we get a fairly easy deal worked out in the next few months or so, where do you see growth, inflation and the general picture for the British economy?
So if we do get a deal agreed, we'll see uncertainty that has obviously been weighing on investment and maybe starting to have an impact on consumer spending as well, lift. So we'd expect a rebound in demand. If we get a deal soon, perhaps we could see growth close to 2% this year and next. In the more likely scenario that it takes a few more months to get a deal, maybe growth of 1.5%, which isn't massively above the 1.4% we saw in January, and then maybe 2.2% next year as more of that rebound in demand is pushed into 2020. In terms of inflation, we think it will probably stay around 2% in all our scenarios, apart from a no deal. But that's based on a different outlook for bank rates. So, we think the bank's going to respond to this change in demand. Like I've said, the labour market's a point where demands should feed through to inflation. So over the next 2 years, perhaps we get 4 hikes if we get a deal agreed soon, and that rebound in demand comes sooner. Otherwise, we wait a few more months, perhaps we see 3 hikes over the next 2 years.
OK, just to follow up on that, if we get this announcement on a deal pushed back into the long grass to the point at which we can't see it 2 years or more, and some people say it could even be longer than that if this Article 50 period is extended out very much further. What happens then? Because markets don't like uncertainty, and that is the ultimate uncertainty, really, where do we go? Does that bring the UK economy down to a halt, or are we going to get used to a new normal? I
mean, it's a really interesting question because, of course, all you're doing is shifting that, sort of cliff edge or, leaving the EU without a deal back. So we think if you have an extension of a year or more, given where the labour market is, we'll probably see the Bank of England get a hike under its belt sort of later this year. Longer than that, perhaps, it's more like a scenario where we get, more of a rebound in demand and perhaps more than 1 hike, two or maybe even 3 if it's a really long extension. But it's just going to depend on how far, whether the economy can sort of go back to normal before starting to worry about the next date where we're due to leave the EU by. OK, we've wrapped up really nicely there because you've also included the longer-term picture of the Bank of England. So we'll leave it there. But Andrew, many thanks indeed for joining us. Andrew Wishart is capital economics economist there for the British economy, taking a look at where we are ahead of the Bank of England interest rate decision at high noon on Thursday.